Welcome to our viewers in both the Netherlands and Belgium. Welcome to this online knowledge session on clean energy. This is the first of a series of Fonds Nieuws and Investment Officer on thematic investing. So very welcome here. My name is Esther van Rijswijk and I will be your host for the next hour. Today we will be speaking to two asset managers about their different approach in investing and in this clean energy trend we are talking about. One believes in active management, the other one chooses the ETF approach. We hope, of course, to get a better knowledge of them on this way of investing, and we hope to get an in-depth discussion, and we hope to be in touch with you, the people at home or at the office. I don't know where you're all at the moment. So please do ask questions in the chat tool that's in your screen. I'm sure you can find it. The moderators will make sure it gets into the studio so that we can discuss it. Our two guests that are waiting for us are Christian Roosing and Christopher Meller. Welcome to both of you. Christian Roosing, you are a senior investment manager of Pictet Asset Management. Where are you at the moment? Are you in London? Or where are you? Oh, Christian is not here yet. But let me start then with Christopher Meller. He's the head of EMEA, ETF Equity and Commodity Product Management at Invesco. Where are you, Christopher?
Hi there, Esther, and thank you for inviting us to join you here today. So I'm based in London, although it's fair to say I've not been into the office in London for almost a year and a half now. So I'm living just north of London.
Yeah. So not getting back to the office yet there.
Not quite yet, but hopefully soon.
Yeah,
fingers crossed.
It's so exciting, isn't it? As we can all see now, Christian has joined us now. Christian Roosing, you're a senior investment manager at Pictet Asset Management. Welcome. Where are you calling into from? From where are you calling?
From Geneva, that's where we are based.
From Geneva. So we have Switzerland, we have London, and we have, and that's where we're going to start, we have our keynote speaker, which is John Kerkhoven. John is the founder and director of research and consultancy firm Kalavasca, which focuses on the energy transition. And he has calculated, amongst others, he's doing all kinds of research, but amongst others, he has calculated the amount of investment that's needed in the Netherlands for the energy transition. And of course, how it can be financed. That's what he will be talking about to us. And of course, the question then also to you, John, where are you at the moment?
I'm at home in the eastern part of the Netherlands.
In the eastern part of the Netherlands. Okay, we're so glad you're joining us here. And you're opening this session here today with a keynote on, well, the cost and how to finance all of it. The floor is yours. Go ahead.
Okay, thank you. What I want to do today is give you a glimpse of what investors can expect when the Netherlands turns itself into a climate neutral country. And it's only a glimpse because we do not know all the details yet. But as time progresses, more and more becomes clear. I want to do the talk because it's a very broad subject in 6 parts. First, I'll talk to you about the energy system and what is needed in an additional investment. Then I will show you how we calculate those additional investments by using scenarios and how those scenarios are being developed and accepted by people. Then within the scenarios, you can see how the energy carriers and the raw materials start to shift, and we start to see what sort of impact that could have financially. And then we'll go into infrastructures, because a lot of these changes will require new or expanded infrastructures. And then finally, I will tie the energy transition to the transition in raw materials and the transition in the agricultural production and food consumption system. So that's the way we will place it. We'll start with the investments into the energy system. And the first step that we did was for a committee called the Committee Solden, which is the committee that was looking over the last couple of months into how to finance the Dutch energy transition. And they asked us the question, what are the investments currently in the energy system? And we came to a number of about 350 billion in assets that are related to energy carriers. Then the next question was, if you look at the future, when you become climate neutral, what is additionally needed? And there, again, approximately 350 billion is the number that comes out. And of those additional investments, quite a large sum goes into infrastructure. A large sum goes into the domestic environment where buildings need to be adapted. And a large part goes into actually central electricity production and electrolyzers. Those are the big areas where the additional investment is needed. Since most of the investments we are currently having done will have to be replaced over the next 30 years before 2050, you can say that the total investment sum is of the order of magnitude of about 700 billion, which in a 30-year period is doable, but it's a large sum. Now, of the additional investment, we also looked into how will this be financed? And there are a number of characteristics that make these investments sometimes difficult to do. And we estimate that about half of the additional 350 billion will not be financed by the market under the current conditions. So the reasons for that is that some investments have a high risk profile because there's uncertainty that this is actually the right solution in the energy transition. Some investments require long capital, which is not always available by all parties. So therefore, if you invest into heat infrastructure, your money is tied up for quite a long period of time, potentially, etc., etc. So that is roughly where we stood on that question from that government committee. Now, in order to make these calculations, we based ourselves on work that we had done in 2020 and 2019, when we were asked by the joint grid operators and the Dutch government to come up with climate neutral scenarios for the Netherlands. And what we did is we produced 4 scenarios, which could be seen as the cornerstones of a playing field. So those are the extremes. And on the left side, you have the regional scenario where people itself in society are very committed to going to climate neutral, where there are local cooperatives, etc., self-sufficiency. So that's a real extreme on that side. On the other hand, you have the European and the international scenario, where either Europe or international trade drives what happens in the energy transition. Now, these scenarios were completely calculated in detail for all energy carriers. Currently fossil fuels and in the future renewables on an hourly basis. And you can also then see how they interconnect to each other, because green electricity could turn into green hydrogen, and natural gas with some CCS could turn into blue hydrogen, etc., etc. So you can start to see these interconnections. And we did that by a tool we had built as starting 2007, which was called the energy transition model. And the energy transition model is an open source, free of charge model in which we have now invested about 15 million euros. And this the company that currently continues that development is called Quintel Intelligence. And because it's open source and funded by a large group of companies and government bodies, it is generally accepted also by the NGOs as the calculation tool to actually do these things, because everybody can look into the tool, how the calculations are made. Now, if you zoom in one level further into those scenarios, you can start to see, and I only take hydrogen as an example, what sort of hydrogen need there will be in 2050. If you also go to synthetic fuels for international shipping, and you go to synthetic kerosene for international aviation, which is the current main route of thought that people have, that's where we're going, the amount of hydrogen we need is enormous. You talk about 4,000 to 8,000 kilotons in the total Dutch situation. For the other large sector is the industry, in which there are big shifts, because you can imagine that in certain scenarios the refineries disappear because the need for petrol and fossil kerosene disappears, and therefore the refineries go down. But there are also scenarios where there is still a limited market for the refineries in exporting their products to other parts of the world that are slower in the energy transition. With chemicals, you see very big shifts in demand because of hydrogen and electrification, but also because some parts become circular, like, for example, in the plastics part of the industry. And with fertilizers, there's also a very diverse image, because there is an official policy by the Dutch government, which is more and more supported on the European level, where they want to go to a circular agricultural economy. And in the circular agricultural system, fertilizers are less needed, at least from the fertilizer industry. So also there's a wide range of possibilities. Now, if we go one step further, because you know what the energy carriers are going to do, and to a large extent where they are located in their use, you can also start to draw in grid detail, and the grid operators did that, what will happen to your gas and CO2 and heat and electricity and hydrogen networks. Now, this is an example of what we are currently deciding in the Netherlands, where the left picture shows you a sort of a ring, which is the hydrogen backbone. And interestingly enough, we have enough gas networks in the Netherlands that about 80% of that hydrogen backbone will not have to be built from scratch, but it's a sort of refurbishment of the natural gas grid, and about 20% need to be net built. And then we can have these hydrogen backbone ready and interconnected to the countries around us by 2026 to a large extent. The 2050 pictures are slightly different. The hydrogen backbone is then extended into certain other parts of the Netherlands. But at the same time that the hydrogen backbone develops, also a part of the natural gas network is repurposed, because in many scenarios, we don't only have hydrogen, but also green gas. And the green gas also needs a grid. So the sort of natural gas grid that we currently have sort of is split off in two purposes, and gets also a different typology. There's one area in the Netherlands where there's huge uncertainty, and that's the industry. And we've started to call it a strategic binary uncertainty. And I'll explain what we mean. And I'll take a simple example. We have one steel plant in the Netherlands called Tata Steel. And originally the idea was that the Tata Steel plant would use a new technology where you use coal more efficient, which is called Hizarna. But then we decided that that might not be a good idea. And then the idea was to capture the CO2 gases, and then we would put them under the North Sea, and we would need a CO2 infrastructure. But now we're at the point that we say, well, maybe we might need to skip that step, and we might go directly to direct reduction of iron with the use of hydrogen. So we don't use the coal to do the iron reduction, but we use the hydrogen. Now, in that example, we need to expand the number of offshore wind fields dramatically. We need to have more electricity infrastructure, and we need a hydrogen infrastructure. But it could also be that we then thereafter decide that the cheapest way to produce green electricity is in a country near the equator where there's a lot more sun than in the Netherlands. And in that case, you might do the iron ore reduction with hydrogen in such a country, and then only the resulting iron that you get from that, you put into small blocks on a ship, and you ship that to the Netherlands, and then only the advanced steel production process is left in our country, in which case you don't need either of the infrastructures anymore. So this is an example of this binary thing. Now, what we've built is something similar to this energy transition model I talked about, which is called the carbon transition model. And it defines for each side of an industry exactly the complete energy and material balance. And it gives you 7 base routes to decarbonize or to undo a site from its emissions. And I won't go, because of the time, into all the details, but I'm sure that the organizers will send you my presentation somehow, and then you can read about the 7 base routes to do that. Now, finally, to conclude it up, it's one thing to think about the energy transition, and as we do, to do some calculations about that and simulations with the energy transition model. It's one thing to do that separately for the industry, but you also need to do it for the agricultural and food consumption side. And I will give you 2 examples why this is so important for the future in making your investment decisions. One is, for example, if a chemical site with steam crackers decides to go to electric cracking, so you go from, say, using natural gas and oil to electricity, then in that particular case, the amount of electricity demand in the Netherlands goes up dramatically. And as a consequence of that, the scope 1 emissions, so the direct emissions of a site, will go down also dramatically. But in order to produce the electricity, until we reach 100% renewables, somewhere in Northwest Europe, a gas plant will probably go on much more often to produce electricity at moments that the renewables don't produce enough. And then you get a substitution of scope 1 emissions with scope 2 emissions, where if that happens in the wrong way around, the society as a whole doesn't make any progress with lowering its emissions. So you need to look at both sides of the equation. The other example is with the agricultural production model. If an industry or if an energy sector decides to go to biomass for energy purposes or feedstock, then of course somewhere these plants or animals will need to be grown in order to produce this biomass. And this will have a consequence on the number of land that you'll have available for food or feed, and it will have a consequence on the mineral balance of the land. So, and since you can only use land once and not twice, you have to think about what is the actual purpose if you're living in a country where the amount of land that you have available is rather limited. So that's also an example where we're connecting the model so that if in an industry they switch from fossil feedstock to biomass feedstock, you can actually see what that means for the implications of where the biomass needs to be grown, in what quantities, and how it impacts the rest of the food and feed system. I will leave it with that for now. I think my 5 minutes is about up, and I'll give the floor back to the host of today.
Thank you so much, John. 5, those were 15 very interesting
15
minutes.
Yeah,
Thank you so much. One quick question. People are asking, amongst others, how are you calculating all this? For example, you said that only half of the total investments will be made by the market. You also mentioned that the tool is open source. Can people find the answer to that question in the tool? Is that where they can find the way you do the calculation?
The easiest way is to go to the report of the Commissie vergt, the Commissie Salden, sorry, the financing the energy transition that was sent to our second House of Parliament, and you can find it on that site. Okay. And then there is a appendix, and the appendix gives the full report on our site, which describes these numbers and where we got them from.
Okay, so there's
and then in the report you find the links to the tool where you can see the detailed calculations.
So those of the people at home who really want to know can find everything. And as you said, we will be sharing the presentation. It will be in the follow-up mail that everybody will be getting after this webinar. Thank you so much, John Kerkhoven.
You're welcome.
Okay. We move on to our first asset manager, and that's Christian Rusing. Christian, welcome back. You are from Pictet, and Pictet is one of the founding fathers, we could say, of thematic investing. It's an independent asset manager overseeing more than $250 billion of investment. It's part of Pictet Group, founded in Geneva almost 2 centuries ago. And Pictet Asset Management is a pioneer, as I said, in thematic equity since 1995. We'll be talking to Christian about the drivers behind the clean energy trend that we're noticing. Welcome, Christian, again. Let us start with, well, maybe the momentum. Although the importance of renewable energy has been quite clear for some decades already, but I keep reading everywhere that the energy transmission now is finally gaining momentum. What has been driving this?
Yes, indeed. Well, hello everyone, and thank you for inviting me to this opportunity to speak to all of you. Well, indeed, we can really say that the clean energy stars have really aligned themselves over the last few years and have really led to the fundamentals of the industry and the companies and the fund to dramatically improve. Finally, all elements are available. We have on one side the increased environmental awareness through our entire society, but also our young generation, our companies, the cities, but also investors are now finally becoming aware that it is time to act and are responding to it. And we have also, most importantly, our politicians, which are now finally taking this issue seriously. And indeed, government action has been truly outstanding over the last 18 months, starting with the EU Green Deal announcement and now having nations combined 3/4 of global CO2 emissions, pledging themselves to a net zero emission target. And the key driver as well of this, another star that is aligning is definitely also technological innovation. I can talk to that a bit more later, but thanks to which it kind of really makes now economic sense to deploy those environmental technologies. And obviously for the politicians, it's now much easier to push those technologies because they are the cheapest and they make an economic sense. So this is really why we are currently experiencing various inflection points within our investment universe, in which entire sectors are being turned inside out with many losers and also some winners. And that's the sector of transportation with the trends towards electric vehicles. We have about 30% exposure in our funds to that sector. It's also the sector of industrials with a new whole wave of manufacturing and the whole use of automation and software helping to operate our factories in a more efficient way. Here we have about 15% exposure in our portfolio. And eventually, of course, it's also about renewables with the penetration in the whole sector of energy. But effectively, it's really for us the entire fund that is experiencing a real turning point and an acceleration in secular growth. So not only those 3 inflection points, and we believe that this inflection point is not yet priced into the share price of those companies.
Okay, so you mentioned 4 major drivers, but which one is really the game changer here?
The game changer is clearly, and that's really the reason why this is happening now and not 5 or 10 years ago or 5 or 10 years from now. It's really technological innovation. And that has really massively reduced the cost of environmental technologies like renewables, for example, that have seen the cost declines by 80 to 90% for wind and solar. Batteries have seen their cost by 90% over the last 10 years. And electrical vehicle, of course, then becoming also more cost competitive. And as a result, those technologies have now finally fallen to cost parity with their fossil fuel-based solutions. And the best example of this, and it's the incredible technological progress in IT, computing power, and also the power semiconductor space, of which we have about 30% in the fund. And that may sound maybe counterintuitive, but the power semiconductors of the latest generation are really one of our best ways to reduce the 70% power losses that occur really throughout the entire energy value chain each time you convert the electrical signal from the wind turbine to the inverter to the final end use in the washing machine, the electric cars, etc. So there's really a lot of innovation happening, and the electrification and digitalization of our society will really require a lot of energy efficient power semis.
Okay, so I'm guessing this means that there's also a lot more investment money going towards clean energy. Is that what you see?
Yes, indeed. There's indeed a lot of money coming into our space, and which is really positive because it also helps obviously the companies accelerating their energy transition themselves. So with capital flowing in, it will really lower the cost of capital of those companies. When we have the opportunity to participate to capital raises, we will do that. And so this is really something that is happening, and that we have seen from clients really taking the will of having a positive impact into their money and really investing in funds like ours.
Okay. Now let's get clear what we are really talking about, because when we talk about the energy transition, sometimes it seems like we're just talking about renewables or about clean energy, but that's quite a narrow definition, isn't it? So what are we talking about?
Yes, indeed. I mean, when we define the way we define the picture clean energy, it's really about the whole energy transition, and the opportunities are really so broad, and there are really a lot of opportunities that are driving this energy transition. They are much broader and much more diverse than just the renewables, as some of our peers, for example, would have defined their investment universe, but which would indeed, as you say, be very narrow and would lack the investment depth. And this is why we've defined really our investment universe in a much more diversified way, really covering the entire energy transition all the way from the energy supply. Here we invest only in renewables. We don't invest anymore in natural gas. We've exited that now about 3 years ago, and renewables have become really much more attractive investment area in the last 3 years. It is now for us the defensive growth pillar of the fund, with a powerful re-rating trend as some of those fast-growing utilities transition towards a greener footprint. On the right side of that slide, you have the energy efficiency and electrification driven sub-themes. On the demand side, you have efficient manufacturing with investments in hardware, but mostly software that helps simulate, manage, and operate our factories in a much more efficient way. You have green buildings with investment in companies offering products and solutions like insulation materials or energy efficient appliances, heat pumps, etc. Finally, obviously, smart mobility with a strong trend towards electric vehicles. And at the bottom of that slide, you see the enabling technologies such as batteries and the power semiconductors I just mentioned, with applications in all other segments. And finally, what is holding all that together is enabling infrastructure segment that are really key to integrate the renewables, the heat pumps, and electric vehicles into the grid. So overall, a very diversified set of end markets that our companies are addressing throughout really the entire energy value chain.
Okay. Christian, we have about 4 or 5 minutes left, and before we want to go to Christopher, and we need to go there because we want the two of you to get to talk to each other as well. So you and I have to decide on where to go fast now. Let's go first quickly to the poll question we have lined up for the people at home on the different sources of energy. So you guys, you get the poll in front of you right now at home. Which one do you think is the cheapest source of electricity generation? And this is without subsidies, isn't it, Christian?
Yes.
Yeah.
Well, what we've seen is that indeed in most regions of the world, renewables are already today the cheapest source, even if you would add 4 hours of energy storage to it. So that and they're not only the cheapest from an absolute point of view, they are the cheapest from a pure running cost, and even cheaper than the pure running costs of coal, nuclear, and natural gas. And they're getting cheaper by the day. Natural gas and coal and even nuclear will rather see an increase in their levelized cost of energy, as they need to comply to ever stricter environmental standards. And this really explains why the utilities invest in renewables from a pure economic point of view, while in the past they were forced to do so by legislation.
I was giving you the floor too quick because you already gave away the right answer. So they kind of guessed it. Most people, 63% thought solar was the cheapest. 17 said wind. Still 13 said nuclear power, but we are not there yet. Maybe those were thinking of the future. Now, some things we have e-mobility that you want to tell us about something, and of course the connection with other sectors. Let's start at e-mobility. Why? It's a big part of your portfolio. Why has this reached an inflection point as well?
Yeah, definitely. And it is really an inflection point that is really happening as we speak. So it really started from January 2020 onwards. 2020 was the first year where the car producers in Europe had strong financial incentives to sell EVs in order to meet the stricter CO2 emission targets, because if they fail to do so, they will face heavy fines. And that, for example, for the Volkswagens of this world, can quickly reach billions of euros. And this, combined with new EV subsidies that have been introduced during the COVID crisis, has really led to the penetration of EVs multiplied by 5 times since 2019. We have indeed, as you said, 30% exposure to this theme through various angles in which we can benefit from this opportunity. The obvious one is obviously smart mobility. You have niche industrial manufacturers of motors or charging infrastructure. You have energy storage supply chain, innovative new materials like silicon carbide that are really key to reach longer ranges or faster charging speeds. But really our preferred way to invest in electrification is through the power semiconductors that have up to 15 times more semiconductor content in an electric vehicle versus internal combustion engine cars. And it is our preferred way because they're a good example of the higher quality companies next to renewables, obviously, which we have in the portfolio, and that have much higher barriers to entry, generate much better profits, free cash flows. And for us, they are extremely attractive because they're still trading at very attractive multiples. And with the electrification and digitalization of our society, they obviously also benefit from other strong trends such as AI, energy efficient appliances, green data centers, 5G, and etc.
Okay, so that way we see that the choices you as an investor are making are actually changing because of those inflection points and those drivers. Maybe we can dive into that a bit more later in the discussion with Christopher. Let's go to the basic question we also always want to know. Are we watching, because it's been, the performance has been good. Are we seeing fundamentals being good here, or are we seeing sentiment?
No, it's indeed the performance has improved, and it's really the fundamentals that have dramatically improved here as well. We're really at the very beginning of that period, and what we've seen, despite some short-term profit taking year to date, driven by rising interest rates and the rotation bit out of growth stocks into cyclical stocks, the fund is really outperforming now global equity markets over 1, 3, 5, and 8-year period. And this improving performance is really happening as we speak. Since the refocusing of the fund early 2019, our performance was of almost 50% over that period, so since 50. And two elements that are really truly remarkable is really that on one side, this outperformance was created in both phases of bull markets, like 2019 and most of 2020, but as well in down markets like the Q1 of last year. And the second element that is really outstanding is that this outperformance was very broad-based and generated by 80% of our sub-segments in each of those phases, and not the result of a one-trick pony, but really by this acceleration of secular growth and improving fundamentals.
Okay. Still, the last couple of months, it wasn't that good. Are we already too late?
Definitely not. I mean, you will definitely not. I mean, the trend, the mega trend of the energy transition is a trend that will last multiple decades. We are at the very, very beginning of these inflection points. As I mentioned earlier on, we have all those net zero targets that are being set right now. Politicians are waking up, and we're really just at the beginning of this acceleration. Essentially, it's 30 years that we have now ahead of us until we reach net zero, and it will never be a straight line up. And after a very strong year of last year, it's normal that you do have some consolidation before it continues.
Okay, thank you so much, Christopher Roosing. You will be staying with us because we will get back to you. But first, we move on now to our next asset manager, because obviously investors can get exposure on the transition towards a climate neutral world in different ways. And from active management, as we just heard, we now switch to index investing at Invesco. Invesco, or our next guest, Christopher Meller, takes an ETF approach. Invesco is an independent investment management firm with $1.5 trillion in assets. And Christopher, as I said before, is the head of EMEA, ETF, Equity and Commodity Product Management at Invesco Limited. Welcome, Christopher. Maybe we should zoom out a bit and start at the whole legislation thing. When we're talking about trends, the environment and what's happening in the world is of course very important, and then legislation is an important one in this one. So it is an driver, I think. From that perspective, what can we expect from the UN Climate Change Conference in Glasgow coming up?
So as you've already heard, and as you've said, legislation is one of the key drivers of the sort of climate revolution that we're seeing. And I think that's coming as a result of, a wider education in society and realization in society, perhaps helped by the sort of the externality of the COVID crisis that we've seen. And we've certainly seen a step change in the appetite for global governments to actually deliver on a climate change agenda. So the COP26 meeting, so this is the UN Climate Change Conference that is meeting in Glasgow later this year, is really aimed at delivering on that long-term goal of keeping global warming to within 1.5 degrees of pre-industrial temperatures. So it's a pretty tight target given the warming we've already seen. And the focus is very much on active steps that we can take to reduce climate change. And you've heard John talking earlier about the sort of size of investment that's required for somewhere like the Netherlands. Obviously, it's several orders of magnitude bigger in terms of the global picture. In terms of commitments, we have seen significant steps from countries in the last 12 to 24 months. Most notably, and most recently in the US hosted a virtual conference back in April, where we saw a number of countries committing to zero carbon plans. And I think you can expect to see more of those countries, or more countries adding to those commitments, including countries like China, which has already committed to zero emissions by 2060. And to put that into context, in terms of the impact on the climate, that commitment on its own works out to somewhere around 0.2 or 0.3 degrees of reduction in warming just from that commitment alone. And there's the potential for greater commitments to come from nations.
Okay, thank you. We were just listening to Christian, and obviously he's an active investor. So he explained to us that the choices you make, since the drivers are changing everything. So, for example, e-mobility, it's really important to watch the whole trend closely and make the proper choices. You don't choose for an ETF approach. So you basically do not make that much choices. Why is an ETF approach a good way to get exposed to this trend?
Yeah, so I'd say that we're making the same choices, but we're doing them in a different way. So the difference between an actively managed portfolio and a passively managed portfolio is really, simply down to what the portfolio manager is doing. So an actively managed portfolio is looking to get exposure to a particular theme through stock selection. A passively managed portfolio is trying to track a specified index, and actually the selection part of the process is built into the index. So, having an index that is exposed to, and you'll find some very similar points made in terms of the index exposure that we offer or that we're tracking. So if we look at what the Wilder Hill Global Energy Innovation Index is doing, it's giving exposure to those broad themes that you've already heard about from Christian. So renewables make up around about just over 50% of the index weight. But on the other side, you've also got around about 15% in the area of energy conversion. Again, we heard John talking about the use of hydrogen as a solution to replacing high carbon fossil fuels in things like shipping, transportation, and industrial uses. You've got 15% exposure to things like storage technology, which includes battery producers that are active in the EV space, but also other electricity storage solutions to smooth over those periods where you have an intermittent supply from renewables. The other area that I'd also emphasise is around about 15% of the weight in the index, and therefore in our portfolio, is in things like energy efficiency. So improving building efficiency, improving building systems and insulation and so on, in order to reduce energy consumption, as well as transitioning the way that we are sourcing electricity. All an important part.
Yeah, Christian just mentioned semiconductors, and I will get back to that later. But do you have it there with you? How much are you in semiconductors? How big is the weight?
Yeah, so we don't have a specific exposure to semiconductors and that energy efficiency through semiconductors. And one of the reasons is that actually you have if you like, an embarrassment of riches in the more directly exposed renewables, energy conversion, energy efficiency, and energy storage space. Often the problem with thematics, and I guess we'll probably talk about it a bit more, but the problem with thematics is really very much getting exposure, clean exposure to a particular theme, and that's true for an active or passive approach. In the clean energy space, as I say, you have an embarrassment of riches. There are enough stocks with pure play exposure to drive a meaningful, relevant investment exposure. The problem I would have, not to be argumentative, with a semi-exposure is that you are exposed in those stocks, if you're selecting those stocks correctly, to companies that have exposure to the power chips, but also within their portfolios they'll have a wide array of other exposures as well. Sort of from a philosophical perspective, maximizing the relevance of your exposure is a key thing when you're looking to get thematic investment ideas to work effectively.
Okay, maybe we get back to that later when we have Christian back with us. Let's go to a poll as well before we continue this conversation. So let's see what our viewers think of an ETF approach. So you all get a poll on your screen right now. And the question is, what to you is the biggest advantage of an ETF approach? What to you is the biggest advantage of an ETF? Is it lower cost? Is it higher returns, flexibility, diversification, transparency, or maybe something else even? So while people are filling in the poll and I start having results in, what to you is the biggest advantage, Christopher?
I've got to say that you sort of listed all the key advantages. Which one is the most important is obviously hard to say.
No, but
ETFs
please choose. Yeah, don't go through all of them. We don't have the time for that. Pick one out.
I think the key thing is transparency and efficiency. So transparency means because you're tracking an index, as an investor, you can look at the index rules, whether it's something as simple as S&P 500 or something, perhaps more in depth like the Global Energy Innovation Index. You can look at the index rules, you can understand exactly how those stocks are being identified and selected, and you know that your ETF manager should be investing exactly in line with that index. So that transparency is key. And then the efficiency side of things, ease of access. You can trade your exposure like a share on the stock exchange. You can get in at exactly the time you want. You can get out at exactly the time you want whenever the exchange is open. You're not relying on the fund manager to provide your access in and out. And the combination of those advantages have driven growth in ETFs, almost exponentially. Currently, if you look at the ETF market in Europe, we're about $1.3 trillion of assets in exchange traded products in Europe alone. Obviously, when we throw in the US, it becomes a much bigger number. And that's been driven by the success of the platform and the advantages that we've just been talking about.
Okay, now let me say, I'll tell you what people at home think is the biggest advantage. To them, it's obviously lower cost. 37% chose that answer. Flexibility, 16%. Diversification, 16%. And once you mentioned transparency, one person voted for it, but that's not enough. Okay, so we said before, there's a lot more money going that way. ESG investing, the whole broad concept of it is very popular. Are the ETFs riding the same wave?
Yeah, so if we look at clean energy, you can think of clean energy as being, a subset of the broader sustainability and ESG universe. So growth in ESG has obviously been very strong in investing in general over the last few years. And actually, if we look at flows into ESG ETFs, so broad sort of core beta replacement kind of dominates the areas that investors are putting their money. But flows into ESG ETFs have made up around about 40% of total inflows to ETFs in Europe, both this year, so year to date, and indeed last year. Within that, we've also seen very strong demand growth for clean energy ETFs. So if we look at the global clean energy ETF space, you've seen something like $10 billion going in, or slightly more than $10 billion going in last year. And we're actually very close to that level again this year, despite that blip in performance that Christian was highlighting in the clean energy underlying stocks.
Okay.
So a very strong theme, and part of that broader trend of a shift to ETFs and a shift to more sustainable investing.
Okay. Now, there's something about ETF investing that you often hear, that people worry if the universe is big enough. And maybe you could even say that it is not truly passive investing, because you are actually making choices. You're not being passive enough. And for example, you're making a choice for this trend. How do you design your investment approach in order to have meaningful exposure and to make sure that you are not making too small a choice?
Yeah, you're right. One of the key things in investing in a theme, a particular theme, so clean energy or blockchain or whatever technological development, there are hundreds of ETFs out there offering exposure to different themes, and indeed there are 100 of active strategies out there also offering similar exposure. The key thing for me when we're designing an ETF to offer a meaningful exposure to a theme is just that, it's meaningful exposure. Very often in early stage thematics, where you're obviously focusing on a long-term secular trend, and very often it's hard to find good quality exposure, enough pure play companies, if you like, to particular themes. So if you think about something like, say, robotics, very often, the largest dollar value of robotics related revenue might be tied up as a subsidiary or a small part of a much larger industrial conglomerate. And that's often a problem for themes. As I said earlier, the nice thing about clean energy is that we do have this broad number of more pure play exposures. And again, the index is designed, that we're tracking is designed to offer exposure to those pure plays. whilst also avoiding, exposure to coal and oil that often come as baggage with some of these renewable exposed areas. And just to go back to your point about the sort of passive versus active, there is always an active decision being made, whether it's from the end investor choosing to get exposure to this theme, and then secondly, either by the active fund manager selecting the stocks, or the rules that are set up in the index, or indeed for the Wilder Hill index for tracking, where that's built off of the expertise of Wilder Hill, who are experts in the clean energy space. They actually launched the first global clean energy index, and that's the index that we're tracking all the way back in 2006, and have been doing that job of identifying the best, most innovative areas of technology in the clean energy space, and continue to do so.
Yeah. Okay, let's get Christian back in the game, and the people at home, because already we have a lot of questions coming in, of course, and it's time we start answering them. So welcome back, Christian. I specifically mentioned the semiconductors because a question came in on that, and maybe we should start with Christian. We already heard Christopher telling us about semiconductors and how he deals with it, or how the exposure is, which I would say is not explicitly exposed. But we have somebody watching, and he says, according to Morningstar, almost 50% of the fund, of Christian's fund, is invested in technology companies. Since when did the fund overweight semiconductor companies in their portfolio? Is it true? Are you overweight? And is it 50% almost?
The 50% refers to IT names, and as you might be aware, it's so overall it's about 25% semiconductors. There are some software companies that are, as I mentioned earlier on the efficient manufacturing side, that help operate and simulate better products and better operations in companies. You also have obviously some solar names that are classified as IT. Typically, inverter names would be classified as IT as well. So the pure semiconductor sector is much lower. And maybe just to come back, semiconductors are really key throughout the entire energy transition. That's I mentioned that earlier on. I mentioned the 15 times more semiconductor content in an electric vehicle, and we really make sure when we select the companies, we don't invest into any type of semiconductors. We just purely invest into the power semiconductors, and those are the ones that are really relevant and important for the energy transition.
Which I think is
invest in memory or anything like that. And we have a very clear purity concept where we look at every single company and make sure that their exposure, that we only calculate, that only take the exposure that is relevant to us, and only invest into the companies that are the most exposed to that. So the purity across our entire fund is well above 65%. So really across the entire fund.
Okay, thank you. And I'm sticking with you for the next question because it's also direct to you. And please be brief so that we can go to the polls. The question is, in which part of the aviation chain, so aircraft constructors, airlines, etc., will you invest to get CO2 down?
Well, at some point, I guess it will make sense to go to invest into the whole synthetic fuel or CO2-free fuel, if you want, and then at some point hydrogen. But aviation is definitely one of the sectors that will be the hardest to decarbonize. Currently, you could invest in light materials. We have, for example, companies like ANSYS that help simulate the different elements of a plane, the weight, the technicals, the strength of materials, so that you can eliminate weight, make more energy efficient engines and more efficient production of planes. So this is really the near terms, and then hydrogen and the fuels. That's more on the midterm phases that you can invest into.
So let's take another poll to see what people at home are thinking. I'm going to go to poll number 3. And the question that we ask the people watching us is about the whole theme. And the question is clean energy an overhyped investment theme? That's the question. Now, obviously, our 2 asset managers do not think so. Otherwise, please raise your hand right now, because we would like to know. But what do you think people at home will be answering? Do you think most of them think it's overhyped, or is it in general people really see this trend going? Christopher?
Yeah, so I think it's very tempting to look at the performance of the sector, or the thematic exposed indices and funds, as Christian was saying. The strong performance you saw last year. I think you talked about 50% outperformance or 50% returns. Yep. Actually, the clean energy index that we're tracking returned 144% last year, which is so that's absolute performance. So
Okay, well, the people agree at home. They also saw that, but they are not. I think you're trying to make the point, Christopher, that you can easily think that maybe it's a hype, but it's not.
Yeah, so it's come a long way, but it's also been in the doldrums for a very long period. Yeah. So you've had a period of sort of performance largely in line with the market, and then very strong performance on the realization that this is a long-term theme.
And the people
at home, there will be bumps along the way.
I'm sorry for interrupting you. The people at home agree with you. 82% say this is not a hype. Let's move on to the next poll, which is about the active management versus. Let me phrase the question, and otherwise I'm just confusing you. So the question is, particularly in a thematic approach, active management is crucial to identify successful companies. So this is a question about active or passive, active or index, active or ETF. And what do the people at home think? Do they think you need active management to identify successful companies? Now, we see the results coming in, and I'm going to be quick here. It's a big winner for yes. 70% says yes, we definitely need active management. You have 20 seconds to say why they're wrong, Christopher. What do they don't see?
So really, it's a question of, are you in the field of picking winners, or are you looking for exposure to the theme itself? Obviously, if you think that you can identify an active manager who can deliver that and pick the winners in the area, then great, active management works. Just remember that just because it's a passively managed portfolio, it's not that you don't have expertise behind it. And indeed, one of the advantages of ETFs is we can partner with experts in all of the fields we're looking at in order to get that deep knowledge and understanding in terms of identifying the stocks that are most meaningfully exposed to a particular theme.
And Christian is just smiling his way through this answer, and we all understand why. We ended up at 2/3. So 67% says you need to make active choices. From that comes maybe a bit the next question, the next poll, which is about engagement. Because investing in the transition towards a climate neutral society contributes to a more sustainable world, but is that enough? Or have asset managers another role to play? We are interested to hear what you think about that. From an ESG point of view, is it important to actively engage in the invested companies? It's not just about making the right choices, but should you also engage? That's the poll question coming up now. And wow, I'm not telling you yet what the answer is. I'm giving the people at home some more chance to give an answer here. But I'm going to go to Christian. Do you engage actively?
Definitely, yes.
Yeah.
Yes.
So your answer is yes, you need to, but why? Why specifically on this theme is engagement so important?
Well, it's for us, it's a clear yes, and it's not just from an ESG point of view. Of course, investors who just want to bet on rising stock prices, they don't care about engagement. But for investors who really want to have an impact with the investment, they want to make sure that they're having a positive impact, and that the managers where they give the money to is is really doing everything they can so that their money is being used for the right purpose, and especially also to accelerate the energy transition and to do something for the planet. So it's really something that we have seen a lot also in the younger generation. Engaging with the company helps them accelerate their own transition. We are providing capital during equity raises and IPOs to fund those energy transition, and this is really the only way to do so. So we are really in constant exchanges with the management and of the companies, and they really value us as active shareholders, really, because we are supporting them in their transition, in their own energy transition and the deployment of their own.
Okay, I'm sure we can spend a whole webinar on talking on how you do the engagement. Maybe that comes up later. But you were nodding, Christopher. But I'm presuming, but maybe I'm wrong, that you are not actively engaging.
Unfortunately, well, I guess fortunately, you're wrong in that assumption. So the reason I'm nodding is that, and I'm going to get in the game of predicting. I hope that the answer to that poll was 100%.
95.
Yes,
it's 95.
Okay. 95.
Okay, explain me what I'm misunderstanding here.
So the key thing is engagement is a key part of the role as an asset manager. So, you mentioned earlier, Invesco is a $1.5 trillion asset manager. Around about 3/4 of those assets are in active equity fund or active funds. The other quarter is in the passive investment side, which I'm working in. All of those assets are involved in the active engagement program that we have. We have a large ESG team at Invesco, and we use all of the assets in both engaging company management and in voting the proxy around that. So it's a key part of the business. It's not enough just to be a passive holder. Just because you're tracking an index doesn't mean you're a passive holder from engagement perspective.
I get it. So as an ETF fund manager, you can actively free ride the active managers then, but it is being done.
we can benefit from what they're doing, and they can benefit from what we're doing as well.
Yeah, let's quickly go to the last poll question and then round up. So the last one is about, which is the most promising sector then when it comes to clean energy? That's what we are asking you guys at home. Which is, according to you, the most promising sector for clean energy? Is it renewables? Is it e-mobility, industrial software, or hydrogen power? And I think we also have nuclear in there, don't we? No, we don't know. Guys, you have to be really quick, so don't elaborate. But again, I know you don't want to choose, but if you have to choose, Christian, which one?
Ability. I would really pick that one because, as I mentioned earlier on, it's an
explained.
On 2020. For me, that's clear.
That's your focus point. Christopher?
I think the most exciting one at the moment has got to be hydrogen. And the reason for that is that it unlocks the other 50% of the global energy consumption that renewables can't really access. So it helps to unlock, as we heard from John earlier, industrial processes, making steel, as well as the transport problems. EV, electric vehicles, may solve passenger transportation, but it's going to be difficult for battery-powered trucking, and battery-powered shipping is certainly not an option.
Okay.
So hydrogen is the answer to that.
And the people at home agree with you. 44% say hydrogen, 25% say renewables. E-mobility is still low, but they maybe after this they will dive into it and then agree with Christian, the people at home. So we're going to have to round up, and I want to give you, the two of you, your last view on this. Maybe a lesson to take home, final words of wisdom. And I'm okay. So I want to start with you, Christopher. What would be your final words of wisdom on this?
I think we've said an awful lot already in the last hour. The key thing is this is a vital change for society, and it's also going to be a long-term trend that is going on, not just for the next few years, not just for the next decade, but as Christian indicated earlier,
zero carbon is the goal for 2050. The reality is an awful lot of that has to happen in order to hit those goals by 2030. So the next decade is certainly going to be a key period for the clean energy space, but also I think for the long term.
Much. Christian, your last final words of wisdom?
Yes, I think what I would clearly highlight here, and the key message is here, that the theme itself is not overhyped. I would say that maybe some pockets of clean energy stocks are trading at mind-boggling valuations because they're being pushed up by money flowing in an undiscriminated fashion in small cap names, very often highly volatile and unprofitable names in renewables, or the hydrogen. That's why before I answered my question on e-mobility, because I was more thinking from an investment point of view. Hydrogen's valuations are just at really mind-boggling levels. So for us, it's really making sure that we invest in high-quality companies. We've completely focused our funds to that, so that we really have now the opportunity to make strong impact also for the environment by engaging with the companies, helping the companies to do that transition in a more effective way, investing in the companies that are really the leaders and are now the most efficient at translating that money that you would invest in our fund into accelerating the energy transition. So really positioning the fund for you to invest and have an impact for the next decade and not for the next 6 months hype.
Okay, thank you so much. Christopher Meller and Christian Ruthing, thank you so much for being with us. And thank you all at home also for being with us today. If you want to learn more about thematic investing, please visit the sections on thematic investing on the Fonds News and the Fund Investment Officer websites. Here you will find articles, podcasts, everything you need to know. And of course, please be back with us because there will be more webinars like this. The next one's going to be in September, and I hope to see you there. Thank you so much.